Hello everyone, welcome to my video. In this video, I would like to talk about how to deal with foreign currency risk. The foreign exchange market is a market where the world currency are traded 24 hours a day. For some, it is simply a mechanism for changing one currency into another. Investing overseas exposes you to investment and currency risk. The investment risk is the probability of losses rather than expected profit from investment due to a fall in the fair price of security. Let's assume that you are a UK investor. Now, imagine you got £1,000 to invest and you decided not to invest in UK market but invested it in the US market. You need to translate it into the dollar first. Let's take the exchange rate of £1 to $1.50. This gives you $1,500 to invest in the US market, and you invested successfully. Well, the investment rise by $500. Now, you got $2,000 of US investment, the original $1,500 plus $500, and you think it is well enough. And you wanted to bring it back at the same exchange rate you invested. Let's say the exchange rate hasn't moved. This becomes £1,333 in sterling, which is a £333 profit on your original investment of £1,000. Let's imagine this time, same scenario, you invested $1,500, rise by $500 to $2,000. When you wanted to bring it back to the UK, the exchange rate has moved. The dollar has weakened. Suddenly, with this new exchange rate, on £1 to $2, only turn back to £1,000 in sterling, which means that the sterling profit is zero. Wait a minute, the investment rise by $500, but the exchange rate has cancelled out all of the gain. Next, imagine the same scenario. The exchange rate happened to be £1 to $1. So this time, the sterling became £2,000. You made the sterling profit of $1,000. Let's discuss why the currency return and the currency hedging matters. The currency and their return can fluctuate considerably over time and can have a meaningful impact on the investor realized return. Investors in foreign equities who do not wish to take a position on currencies should consider hedging currency risk. This allows an investor to make a direct investment in a foreign company without currency risk. Hedging currency risk also can significantly reduce the volatility of equity investments. Let's talk about the option. A currency put option is a hedging contract that gives the holder the right but not the obligation to sell a specific currency at a specific price within a defined period of time. A currency call option is the opposite of a currency put option. A currency put option is a hedging method companies use to protect themselves against depreciation of a currency below the specific put option price. It protects the holder from losses due to exchange rate depreciation. Let's look into this question together. An SCUK London will receive $1 million at the end of 6 months. To hedge its currency risk, it buys an option allowing it to exchange dollars for pounds at a rate of 0.64 pounds to dollar. And you are given the following informations. The below are my explanations. SCUK London will receive $1 million at the end of 6 months. This company has risk associated with fluctuation in the value of dollar versus the pound. The weaker dollar or the stronger pound is favorable as the company has to sell the dollar, receive and buy pounds after 6 months. Therefore, to hedge the currency risk, SUK London could long a put option on dollar or long a call option on pound. In this case, SUK is selling dollar for the pounds. Therefore, buying a call at pounds is the same as buying a put on dollar. The question stated that the spot exchange rate is 0.65 pound to dollar. So, SUK company can buy a put option on dollar that allow it to exchange dollars for pound at a rate of 0.64 pound to dollar. The weakening of dollars is hedged. If the dollar remains above 0.65 pounds to dollar, the strike price is clearly less advantageous to the SUK company than the current exchange rate. So, the option is said to be out of the money. But if the dollar drops to 0.64 pound to dollar or below, the option is said to be in the money. Therefore, the conclusion is the SUK company can buy a put option on dollar or buy a call option on pounds. Thank you.